Resources held steady yesterday. Could this be a positive sign for commodity players? Well, joining us is Kairinos. He's a commodities trader at RMB. Of course, Michael Traherne is still with us. Chris, thanks for coming in. It's been a while since we've seen you. Help us make sense of the movements that we've seen from, or the commentary from the ECB. What impact has that had on commodities?
Yeah, so yesterday, Mr. Mario Draghi, Super Mario, came out with a very dovish tone, bringing up topics of buying equities as well as corporate debt into the QE program. Market wasn't really anticipating this, so ultimately what happened is you saw a lot of dollar strength coming through and a lot of euro weakness. Usually what you see with commodities when this happens is you see a negative effect. When you see dollar strength, you usually see commodity prices come off. The reason for this is that there's less purchasing power to buy the commodities simply because all commodities are priced in dollars. It's changing a little bit with Russia and China. Now Russia sells all of their crude to China in yuan terms, just out of a matter of interest. So you should have seen commodity prices come off yesterday. We didn't. We saw copper prices rally up to $100, retracing quite a bit, and that's a bit counterintuitive. The reason why this happens is because monetary policy is supposed to be there to uplift your economy. And we've been seeing easy monetary policy for the past 4 or 5 years. And what have we seen? All we've seen is asset inflation. You really haven't seen inflation coming down to your real economy, your real products. And this is a bit of a strange situation, and mainly because now all the monetary policies in the world are on the same level. And it seems that most of the central banks only know of this tool. It's working in some aspects, not working in other aspects. How it affects commodities is that because interest rates remain low, you have what ends up being cheap capital, cheap financing, cheap sources of income to actually keep your business running longer than usual. This has led to what we have today, excess supply. So that's from the supply side. You have what happened with China from 2008 till today, well, recently, this excessive demand. But where did that come from? Again, easy monetary policy. In 2008, when the economies across the globe fell apart, China went massive into easy monetary policy, and they said to each subdivisions, we want you to focus on GDP. The bigger your GDP figures, the more that we will reward you for it. And naturally, every person goes and expands their GDP. And through your avenues that you know how. There's easy cash, low interest rates. Let's just build and build and build and build. And that led to this massive demand in commodities and a bubble, essentially. And that's been deflating. I mean, we've seen it with oil first. Copper's going through it. Iron ore was also one of the first ones. Copper a little later than iron ore and your other building materials because it's considered to be a later phase commodities.
So in terms of, let's assume Granny Yellen next year decides, okay, now's the time we're going to start raising interest rates and the rest of the world follows. What do you think happens to commodity prices from there? Because obviously that's quite a bit of a shock to the system, even if they're expecting it.
First and foremost, if it happens, so it happens on day one. It'll take time to filter through, and I think it should be the correct thing to normalize monetary policy. But what's more important in the commodity space is simply that this overinvestment it's sunken costs. So that needs to be worked through over time. So once you see interest rates start rising and capital isn't as cheap as it used to be, it should take 2-3 years before your mines and your oil fields get through this excess supply. Because usually how mines work, if you've spent 100 Rand, and now you're running at a marginal loss because your barrel of oil or your ton of copper is being sold at a price lower than what it costs to get out the ground, you'd rather take marginal loss than just shut the mine today. So naturally, you have this normalizing of interest rates, and say growth does come up to a level that is normal, which isn't really what's in the forecasts for the next couple of 6 months or a year, who knows. It takes time for that supply to work out. So it seems like we're in the space of commodity prices lower for longer.
Lower for longer. Chris, thank you so much for coming in, squeezing in a lot of information in a short amount of time, and always a great value to have you. Thanks so much to Kairinos. He's a commodities trader at RMB.